Good morning, everyone. I hope you're able to see the screen and check my video. So today we will continue where we left yesterday. First, we'll have a basic understanding of common control business transactions, and then we'll do a problem where we understand how do we handle common control business combinations and also reverse acquisitions. Right. So these are the two aspects that we will be covering today. Detailed question from the study material that we'll be covering has been tested quite a few number of times, and very important from the examination point of view. Now, what are common control business transactions? For that, we need to take one example. Let us say we have Reliance Industries. Reliance Industry is the parent. Reliance Industries hold 80% of Reliance Retail. So, Reliance Industries hold 80% of Reliance Retail, which means Reliance Retail is a subsidiary. This is a subsidiary. Now, the question is, who controls Reliance Retail? Reliance Industries. Reliance Industries controls Reliance Retail. Let us say Reliance Retail has another subsidiary called Reliance Digital. Reliance Retail holds 100%, or it can be less than 100% also. 100% of Reliance Digital. Now, if you look at the chain of control, Reliance controlling Reliance Industries, Reliance Industries controlling Reliance Retail, and Reliance Retail controlling Reliance Digital. Right? Now, sometimes what happens is, as a reorganization process, for example, Reliance Industries want to list Reliance Retail. They want to list Reliance Retail without involving Reliance Digital. Means they want to remove Reliance Digital out of Reliance Retail and they want to list Reliance Retail. Now, in that kind of scenario, what happens or what could happen is Reliance Industry may float or Reliance Industry may directly take over Reliance Digital. Meaning to say, the Reliance Digital, the business of Reliance Digital is directly transferred to Reliance Industries. So, Reliance Retail, in other words, has transferred Reliance Digital to Reliance Industry. Now, what has happened? Reliance Industries directly controls Reliance Digital. Now, here also, if you see, Reliance Digital was ultimately controlled by whom? By Reliance Industries. After the reorganization, this Reliance Digital is controlled by whom? Again by Reliance Industries. Now, here, the control has not changed. Reliance Retail has sold the business to Reliance Industries. Reliance Industries has acquired a business, but ultimately, if you look at the group, the control has not changed. Reliance Industries used to control earlier also, now also Reliance Industry is only controlling. These kind of transactions are called common control transaction, where the control before the transaction and after the transaction, or control before the combination and after the combination, does not change. Now, it can be an entity controlling other entity. It can be a person controlling other entity. For example, if Mukesh Ambani controls Reliance Industries and now Mukesh Ambani is directly controlling Reliance Digital, in that case also we say it is a common control transaction. Means, though there is a business combination, but the control has not changed. The control before and the control after has remained the same. Now, when that is a common control transaction or common control business combination, how do we account for it? That is the main part. So, a common control business combination means a business combination involving entities or businesses in which all the combining entities or businesses are ultimately controlled by the same party or parties both before and after the business combination, and that the control is not transitory. Now, control is not transitory meaning cases where sometimes what happens is, in the same scenario, Reliance Digital was separated only for few months or only for a couple of months. Ultimately, this Reliance Digital was sold to a third party. Let us say this Reliance Digital was acquired by Tata. Okay. So first they moved Reliance Digital outside Reliance Retail and brought them under Reliance Industries. That is the first step. And then ultimately Reliance Digital was sold to Tata. Now this control movement was transitory. The control movement was transitory. In this case, it is not a common control transaction, right? So that is one thing you have to keep in mind. Theoretically, this has not been tested, quite often. More importantly, the question that we will be solving in two scenarios, that will be very, very important. Just let me plug in the charge. Common control business combinations include transactions such as transfer of subsidiaries, businesses between entities within a group, right? So that is what is considered to be a common control business combination. Now, how do we account for common control business combination? We follow the pooling of interest method. Now, pooling of interest method, if you remember, you would have learned about it in AS 14. So here also we will apply pooling of interest method. Now, this is one exception that we need to understand, that whenever we follow pooling of interest method, we will not use fair value of assets and liabilities. The assets and liabilities of the combining entities are reflected at their respective carrying amounts only. So, you will consider the carrying amounts and you will recognize the assets and liabilities. Then, you will not make any adjustments to reflect fair value changes or recognize any new assets or liabilities. So, because the control is not transferred, so it is like, let us say there is a father, there are two sons, or there is one son, there is one daughter, whatever is the case. Father is controlling both the children. Business is moving from one children to another children. Ultimately, it is controlled by whom? By the father. So, nothing new can be created. Nothing can be changed with respect to fair value. You will transfer everything at carrying amount. Only adjustment that is permitted is to ensure consistency in accounting policies. Right? Then, the previous period or prior period financial statement should be restated as if the business combination had occurred from the beginning of the earliest period presented in the financial statement. So, whenever you restate the prior periods, you will restate as if business combination has occurred from the earliest period of the financial statements which is presented. Then, all the securities which are issued will be recorded as nominal value. So, if you issue shares, you will record the shares issue at nominal value only. And other than cash, other assets will be recorded at fair value. Other than cash, assets are recorded at fair value. And then the balances of retained earnings will be combined, or you will take it to general reserve as the case may be. So, very simply put, in a common control business combination, what we will be doing is, we'll follow the pooling of interest method. Assets and liabilities recorded at carrying amount. No adjustment will be made for fair value, means asset and liability will not be shown at fair value. Then consideration will be recorded. If it is equity or securities issued, nominal value. Cash, the amount of cash given. Other assets, fair value. So, two aspects. One, assets and liabilities being incorporated will be done at carrying amount only. But consideration that is being paid will be recorded at fair value. Okay, so that is one aspect. Then balance in retained earnings, whatever is there, will be aggregated in the final account or in the financial statement of the transferee. Now, what we'll do is we'll take up a question from the study material AX BX, very important question again, which you need to understand. So let me just add the screen. I'll share the screen and we can move ahead with that. Okay, so here if you see the question, illustration number 38, mark it as very, very important even from examination point of view. This will help you understand how to do reverse acquisition and common control transactions. Okay, now here there are three entities involved, AX, BX and ABX. Question has been tested in the examination as well. AX and BX Limited amalgamated from 1st of January of year 2. So that is the date of amalgamation. A new company, ABX Limited, with shares of rupees 10 each, was formed to take over the businesses of the existing company. So two companies combined, a single entity, ABX Limited. The balance sheet summarized, balance sheet is given below. Assets, you have PPE, financial assets, investment, then current assets, equity and liabilities, in which you have equity, liabilities, non-current liabilities and current liabilities. Then you have breakup of other equity, general reserve, P&L, investment allowance, export profit allowance and all of that. ABX Limited issued requisite number of shares. Who is issuing? ABX Limited issued requisite number of shares to discharge the claims of the equity shareholders of the transferor companies. Also, new debentures were issued in exchange of the old series of both the companies. Please remember, if you are settling debentures by issuing debentures, that is not purchase consideration. Okay. Prepare a note showing the purchase consideration and discharge thereof and draft the balance sheet of ABX Limited, assuming that both of the entities are under common control. So, first scenario is both the entities are under common control, meaning to say, prior to that, whoever was controlling, the same entities will be controlling them subsequently. That is the first scenario. Second scenario, ABX, assuming that BX is a larger entity and the management will take control of the entity of ABX Limited. Now, in the second scenario, what happens is ABX is the entity which is issuing shares. So legally, who is acquiring? Legally, ABX is acquiring. Legally, ABX is acquiring. Whoever issues shares legally acquires the other companies. But BX is the larger entity. BX is the larger entity and BX will take the control of ABX Limited. So think of it. Actually, ABX is issuing shares, but for accounting purpose, we'll assume that BX is the accounting acquirer. Substantially, BX has to do the accounting for acquisition. Hence, BX is the acquirer. In that case, what will happen? In that case, BX will be doing something called as reverse acquisition accounting. Actually, ABX is issuing shares, but BX will be doing the accounting for this, right? So this is one question, pretty simple question if you ask me, but very, very important from examination point of view as well. So let me just take a screenshot so that I don't need to come back again in Excel. So same question we'll be doing in two scenarios. One, your common control transaction, and second, the reverse acquisition scenario. Now, here they have not told us how many number of shares are issued. If you look at the question says that they have issued requisite number of shares to discharge the claims of equity shareholders of the transferor company, which means they have not told us how many shares have been issued. Now, how do we determine the number of shares? See, generally, if the number of shares are not issued or number of shares are not given, the next thing that we can do is to determine how much is the net worth of each of the company. How much is the net worth of each of the company, and considering the net worth, how many shares should be issued? That is, what is the net asset of each of the company and how many shares have to be issued in each of the scenario, right? So now, in the first case, when we are saying it is a common control transaction, please note all the assets and liabilities will be taken at their respective carrying amount. We will not incorporate fair value. So, net assets of AX Limited and BX Limited. Okay. How much is the net asset of AX Limited? Simply put, you can see total of assets 13,050. Total of assets of BX 15,200. Then total assets. Total liabilities. Total liability, if you see 3,000 plus 1,000, 4,000. Here it is 4,000 plus 1,500, that is 5,500. And because it is a common control transaction, one more thing that you have to keep in mind is even the reserves, the other equity and reserves that we have, that also will be considered when we have to determine the purchase consideration, because you will incorporate everything. You will incorporate all the assets, you will incorporate all the liabilities, you will also incorporate the other equity. So how much is the other equity? Other equity is 3,050 and 2,700. So purchase consideration for common control transaction will be 13,050 minus 4,000 minus 3,050, that comes to 6,000 for AX Limited and 7,000 for BX Limited. I am repeating once again, when there is a common control transaction, the purchase consideration will be only to the extent of, actually if you see this 6,000 and 7,000, that forms part of your equity share capital only, right? So this 6,000 and 7,000 that you have calculated is actually nothing but the equity share capital. So the idea behind common control transaction is we will issue shares, or we'll make the purchase consideration only in face value, only at the face value securities that we are issuing, and because we are incorporating everything, we will consider only the equity component as the, except the other equity, only the share capital component I should say, as purchase consideration. In examination, what I have to calculate? What is the total asset taken over, total liabilities taken over, other equity taken over, the net amount becomes the purchase consideration. So 6,000 is for AX Limited and 7,000 is for BX Limited. Any questions so far? Okay. Now, total shares at face value to be issued is 6,000 plus 7,000. Now, if I issue 6,000 to AX and 7,000 to BX, they will not be happy. Why they will not be happy? Because if you look at the net assets, of AX Limited, if you see 13,050 minus liability 9,050, and here 15,200 minus 5,500, if you see, you get 9,700. Means which has more net worth or which has more net assets? BX Limited has more net assets. Right? So when BX Limited has more net assets, they will want higher shares. So this 13,000 total shares that we will be issuing, we should split that between AX 9,050 and BX 9,700 in this proportion. So shares to be issued, the total net assets taken over is 18,750. So 9,050 divided by 18,750 multiplied by 13,000. So that gives me 6275 for first entity. 6274.67 rounded up to 6275. And for the second entity, it will be 9,700 divided by 18,750 into 13,000. That gives me 6725. So what you have done is, again, to understand better, when there is a common control transaction, the purchase consideration that will be issued will be the total assets minus total liabilities minus other equity. That will be the purchase consideration part. If the question gives us the purchase consideration, you will take the same amount. But if the question doesn't give us the purchase consideration, this is how you will calculate. Then net assets taken over 9,050 for the first entity, 13,050 minus 4,000, 9,700 for the second entity. So total net assets taken over is 18,750. In other words, AX Limited gave me 9,050 of net assets. BX Limited gave me 9,700 worth of net asset. Now the total shares that we have issued or that will be issuing will be 13,000. That 13,000 we have to split between AX and BX in the ratio of 9,050 and 9,700. So we get 6275 and 6725. Now once we have done that, to prepare the combined balance sheet is not a challenge at all. Now how do we prepare the combined balance sheet? Simply add line by line item. ABX Limited, the combined balance sheet. Now in the combined balance sheet, we'll add items line by line. So what is the first item? You have taken over property, plant and equipment, which is 8,500 from AX plus 7,500 from BX. I hope the screen is clear. Yeah. So 16,000 is for ABX Limited. Then financial assets that we have as investment. Now how much is the investment? Investment also is taken over 1,050 plus 550. So all at carrying amount only. All at carrying amount only. So I think I'll write it here. 1,050 plus 550, which comes to 1,600. Then inventory is 1,250 plus 2,750, that is 4,000. Then trade receivables 4,000 plus 1,800, 5,800. Cash and cash equivalent 400 plus 450, that gives me 850. Now as far as the capital is concerned, we have issued 13,000, so 13,000 will be the capital. Other equity as it is 3,050 plus 2,700, 5,750. Then debenture also, they have said that they have issued new debentures, so you will take new debentures at 7,000 and trade payables 2,500. So this is how you will do when there is a common control transaction. This is how we will do the accounting for it. Now the second scenario where the question says that it is not a common control transaction but it is a reverse acquisition. Now in the reverse acquisition, we need to consider the fair value. So let me just take the fair value of the assets. The fair value of the assets of AX and BX Limited are given: property, plant and equipment 9,500 and 1,000, inventory 1,300 and 2,900, and fair value of the business totally is 11,000 and 14,000. Right. Now in the second scenario, what we have to do is we have to take the fair value, we have to determine the purchase consideration accordingly, and also we need to see which entity will take over. That is, if it is not a common control transaction, then who is controlling? So fair value of business is how much? 11,000 for this, 14,000 for this. Okay. Now, if fair value of business is 11,000 and 14,000, and what is the question said? You are making issues. You will make shares issue, right? So when you issue shares, number of shares that you will be issuing. See, here in this question, it is at face value. In other cases, it can be at any other value as well, right? So here, number of shares to be issued is 10. Face value is 10. So number of shares that you will be issuing is 11,000 by 10, 1100 and 1400. Please understand, the total value of business of AX is 11,000. Total value of business of BX is 14,000 in fair value. So whenever I am issuing the shares, I'll consider the fair value and I'll issue the shares. I'll consider the fair value and I will issue the shares. So 1100 and 1400 will be issued to AX shareholders and BX shareholders. I will issue 1100 shares to AX shareholders, 1400 shares to BX shareholders. So what is the total? Total share is 2500. What is the percentage held? Percentage is 1100 divided by 2500, that comes to 44%, and 1400 divided by 2500, that comes to 56%. That is where the question says BX is the larger entity and BX will control the combined entity. So when BX controls the combined entity, but BX is not issuing shares, BX is controlling the combined entity, but BX is not controlling the BX is not issuing the shares. However, BX will account for it as if BX has done the acquisition, because BX is the larger entity and BX management is taking over the control of the combined entity. Right now, very important thing that we need to understand here is, if BX has to control, notionally, how many shares should BX issue? That is, how many shares should BX issue such that BX will be the controlling entity? Again, I am repeating. Actually, issue of shares is by ABX Limited. Actually, who is issuing the shares? ABX Limited. How many shares? 1100 to AX, 1400 to BX. That is the actual issue. But if BX is the accounting entity, means BX will do the accounting for it, then how many shares? The question is, how many shares should BX issue such that BX controls 56% and AX controls 44%. We are not actually issuing shares. Again, I am repeating, we are not actually issuing shares, but notionally, how many shares should BX issue? How many shares should BX issue such that BX controls 56% and AX controls 44%? What we are saying, we need to give 44% stake to AX Limited. Now, if BX has to issue, if you come back to the balance sheet of BX currently has 7,000 in total value, that is 700 shares. So, number of shares in BX is 700. Number of shares in BX is 700. And this represents how much? 56%. This represents 56%. That means I need to issue 44%, or I need to first calculate how much should be the 100%. 100% will be 700 multiplied by 100 divided by 56, that is 1250. So BX currently has 700. BX should control how much? 56% shares. If BX has to control 56% shares, the total number of shares should be 1250. That means issued to AX will be 1250 minus 700, that is 550. So notionally, BX will issue 550 shares to AX Limited. 550 shares to AX Limited, right? So total shares issued to AX is 550 total value of business of AX is how much? 11,000. Or total number of total value of business is 11,000. So 11,000 divided by 550, fair value per share becomes 20. Are we clear with this? Any question here? So step-by-step approach if you have to follow when there is a reverse acquisition. First, check what should be the percentage controlled by the accounting acquirer and the other entity. That is the first thing. Second, how many shares should the accounting acquirer should notionally issue to the other entity such that the controlling stake doesn't change. So here BX will control 56%. So if BX has to issue shares, thinking that BX is acquiring AX Limited. So the way the accounting is done is as if BX is acquiring AX Limited. If BX has to acquire AX Limited, BX has to issue how many shares? BX has to issue 550 shares to AX Limited. So that AX has 44%, 550 out of 1250, it has 44%, and BX continues to hold 56% in the combined entity. Okay, no questions? Now, when the business combination happens and there is fair value of fair value accounting to be done in case of reverse acquisition, so what we'll do, we'll have to calculate goodwill or capital reserve. Now for calculating of goodwill, property, plant and equipment, the value is 9500, fair value is given here. Then inventory 1300, fair value is given there. Then others will take at the existing values. Investments 1050, trade receivables 1800 and 450. Investment 1050, then trade receivables 1800, cash 450. These are the assets taken over. So this also, the accounting is done as if BX has acquired AX Limited. BX has acquired AX Limited. 14,100. Then liabilities, if we see, 3,000 and 1,000. So 4,000 is the liability. Debentures 3,000. Trade payables 1,000. Total is 4,000. Okay. So net assets 14,100 minus 4,000, you get 10,100. Purchase consideration. Now purchase consideration is what? Purchase consideration in this case is the fair value of the business or what we have calculated, right? Total value of the business or number of shares into fair value per share. So total consideration is 11,000, which means 11,000 minus 10,100, which is 900. 11,000 minus 10,100, which is 900. Please remember, we have issued shares and we have acquired entire AX Limited. Now, AX Limited shareholders currently control 44% in the combined business and BX controls 56% in the combined business. So, we have goodwill at 900. Now, once that is done, we can directly prepare the combined balance sheet of both the entities. So, this is common control, this is reverse acquisition. Now, in case of reverse acquisition, it will be as if BX Limited is preparing the financial statements. So, 7,500 plus the fair value that we have considered, which is 9,500. So, after you calculate goodwill, it is just a step-by-step addition. 9,500, you get 17,000. Then investment, you have 550 your own plus 1,050 acquired. Inventory 1,300, if I remember right, 2,750 plus 1,300. Then trade receivables 5,800, cash and cash equivalent 850, and we of course have goodwill which we have calculated to be 900. So this is the asset side. I am not doing a detailed working. Sorry. I'm not doing a detailed working because you can calculate, you can do the detailed working of addition of amounts and all of that on your own. So that is on the asset side. Now equity side, existing equity 7,000 plus how many shares we have issued? We have issued, I guess, 550 shares. So 7,000 plus 5500, that makes it 12,500. Then other equity, I have 2,700 plus, I will not take the retained earnings, but there is a issue of share at premium. So 5,050 into 10, the securities premium will come over here. The face value is 10, the issue price is 20, so that extra 10 will come over here, that is 8,200. Borrowings will remain at 7,000 and trade payables will remain at 2,500. So if I do the sum of this, I get 30,200, right? So this is how we do the we do the accounting when there is a case of reverse acquisition, right? So we have done common control transactions and we have also done the reverse acquisition case. Any questions so far? Okay, no questions. Thanks for the confirmation. Okay. So what we'll do is we'll have a look at one more question. We'll discuss that and you can solve it subsequently. H Limited acquired shares of S Limited, a listed company, in two tranches mentioned in the table below. 1st of November of year 6 and 1st of January of year 7. 15% and 45%. Now, first they have acquired 15%, then they have acquired 45%. For 15% you don't get control, for 45% you get control, right? So acquisition date accounting will happen on 1st of January only. Both the above mentioned companies have rupees as their functional currency. H Limited acquired control over S Limited on 1st of January as can be seen here, following the balance sheet on the date of acquisition. Carrying value, fair value. So they have non-current asset, intangible asset, financial asset, inventories, financial assets, trade receivable, cash held in functional currency, other current assets, and that includes non-current assets held for sale, total assets, then share capital, other equity, you have non-current liabilities and current liabilities. Okay, other information. Following is the statement of contingent liabilities of S Limited as on 1st of January 2007 of year 7. lawsuit filed by a customer for a claim of rupees 2 crores. So a customer has filed a lawsuit for how much? 2 crores of claim. Now, if the lawsuit has been filed for 2 crores, that is a contingent liability. As far as the entity is concerned, it is a contingent liabilities. The fair value has been given as 0.5, and they have said that it is not probable that there will be an outflow of resources. Okay, so when there is no outflow of resources, what do we do? What do we do when there is no outflow of resources? You will not take the entire 2 crores, correct? But the fair value of the contingent liability should be recognized. Fair value of contingent liability should be recognized because fair value, that is the valuation you have done. Okay, 2 crores is outstanding. I have to pay 2 crores, or the lawsuit is for 2 crores. But I have determined the fair value. When I have determined the fair value, then the fair value of 0.5 crores should be recognized. Are we clear? Then income tax demand of 7 crores raised by tax authorities. S Limited has challenged the demand in the court. Again, 2 crores is the fair value. That fair value we will recognize. So when we determine the purchase consideration, both of these will be reduced from the net assets that is acquired. S Limited has given an undertaking, indemnification undertaking to H Limited for a maximum of 1 crore. Now think of this. I have to pay, there is a contingent liability of 2 crores and 7 crores. However, fair value is 2.5 crores. So my contingent liability fair value that I will be recognizing is 2.5 crores. It is 2.5 crores. Now, if it is 2.5 crores of my liability, what is the other party saying? The other party is saying that, boss, up to 1 crore I will reimburse. Up to 1 crore we will reimburse. So if I will reimburse up to 1 crore, then 1 crore will be my indemnification asset. So on the asset side, I will add 1 crore. On the liability side, I will reduce 2.5 crores. Any amount which will be received in respect of the above undertaking shall not be taxable. So this 1 crore will not be taxable. Okay. The tax basis of asset and liability of S Limited is equal to their respective carrying values recognized in the balance sheet. So whatever is the tax base of the asset and liability, they are equal to their carrying amount in the respective balance sheet. But if at all there are any differences, for that we need to calculate deferred taxes. Carrying value of non-current asset held for sale 4 crore represents its fair value less cost to sell in accordance with relevant Ind AS. So as far as the relevant Ind AS is concerned, that is Ind AS 105 is concerned, fair value less cost to sell is 4 crores. But please remember, here we will consider fair value less cost to sell and will not consider the fair value. Here if you see the fair value, they have said non-current asset held for sale is 4.5. Non-current asset held for sale, the fair value is 4.5. But as far as the measurement exception is concerned, non-current assets which are held for sale, they are also measured at fair value less cost to sell and not at fair value. In consideration of the additional stake purchased by H Limited on 1st of January, it has issued to the selling shareholders 1 equity share of H Limited for every 2 shares held in S Limited. Fair value of equity share is 10,000 per share. So basically what they have done is, the selling stake shareholders on 1st of January, we have issued 1 equity share for every 2 shares held. So we have issued equity shares 1 for every 2 shares held. Fair value of those shares is 10,000 per share. So this will help us to determine the purchase consideration. On 1st of January of year 7, H Limited has paid 50 crores in cash to the selling shareholders of S Limited. So cash is paid 50 crores, shares issued, and they have additionally on 31st March, S Limited will pay 30 crores to the selling shareholders of S Limited if return on equity of S Limited for the year ended 31st March year 9 is more than 25% per annum. H Limited has estimated the fair value of this obligation as on 1st of January and 31st March as 22 crores and 23 crores respectively. The change in fair value of the obligation is attributable to the change in the facts and circumstances after the acquisition date. Now, what is the meaning of this? We have issued or we have agreed to pay 30 crores to the selling shareholders if return on equity is higher. What is the fair value on date of acquisition? Fair value on date of acquisition is 22 crores. So this 22 crores will be relevant for my purchase consideration. So what about this 23 crores? That is happening subsequently. It is not because of facts and circumstances existing on the date of acquisition. It is because of changes in facts and circumstances after the acquisition date. So this increase of 1 crore will not be considered in purchase consideration. You will take it to P&L. You will take it to P&L. Then quoted price of equity shares of S Limited on various dates are on November year 6 350, 1st of January 395, 31st of March 420. So for us, the valuation that is relevant is 395. So valuation that is relevant is 395. 395 will be the fair value of the existing stake. Then on 31st of May, H Limited had learned that customer relationship existing on 1st of January, which met the recognition criteria of an intangible asset as on that date, were not considered during the accounting of business combination for the year ended 31st March of year 7. The fair value of such customer relationship on 1st of January was 3.5 crores. Assume there is no temporary difference. Now, please remember, we have 1 year of measurement period. We have 1 year of measurement period. Now, this is after, not after, okay. This is within 1 year. On 31st of May, you realized or you recognize that, yes, there is a customer relationship. In that day, what we will do, in that case, what we will do, this portion, you will account for it retrospectively. Okay, then. On 31st May itself, S Limited further learned that due to additional customer relationship being developed during the period of 1st of January to 31st of March, the fair value of such customer relationship has increased to 4 crores. Now, this is a subsequent increase. And if there is a subsequent increase, that subsequent increase you will not consider. So, the thing that you have to keep in mind is whatever is existing on the date of acquisition, that you will consider. But whatever is developed subsequently, that you will not consider. Then, on 31st December, H Limited has established that it has obtained all the information necessary for the accounting of the business combination and that more information is not obtainable. H Limited and S Limited are not related parties and income tax applicable rate is 30%. Now, please remember, we have not discussed Ind AS 12 as of now, but still, whenever there is income tax rate given, whenever there is a difference between the carrying amount and the book value, carrying amount and the fair value, for the difference, you will account for DTA and DTL as applicable unless the question says there is no deferred tax implications. First question, what should be the goodwill or bargain purchase to be recognized by H Limited in its financial statement for the year ended 31st March? For this purpose, measure the non-controlling interest using proportionate share of the fair value of the identifiable net assets of S Limited. So, first we need to calculate the net asset. So, let us get into the working. This is question number 12. Now, first thing, purchase consideration. Now, when you talk about purchase consideration, here we have multiple aspects around purchase consideration. So, first purchase consideration that was paid is your shares issued. That is the first thing. Then after that they have issued your cash paid. So that is the second part. Then you have cash paid, your own equity given. Then there is a contingent consideration. Then there is an existing stake. So shares issued. Now when we talk about shares issued, the question said 1 share for 2 shares. 1 shares for 2 shares have been issued. 1 share each for 2 shares have been issued, right? Now, how many shares are there? So, I'm not able to share both the screens simultaneously. Actually, or I'll do one thing. Just give me a moment. Just give me a moment. Yeah, I think this is better. I can show both the screens. Yeah. So this I can easily actually show you the question. Okay. So now shares issued. How many shares has the question said? 2 shares for, sorry, 1 share for 2 shares have been issued. 1 shares for 2 shares have been issued. Now how many shares are there totally? Totally they have 12,000 shares. Total they have 12,000 shares. 12,000 shares. Okay. 12,000 shares. Out of this we have acquired 45%. 12,000 shares. Out of this we have acquired 45%. Right. For this we will issue 1 share for 2. So divided by 2. So 12,000 into 45% divided by 2. 12,000 into 25%. Sorry, 45% divided by 2. So 12,000 into 45% divided by 2 into 10,000. So it's in crores. So I'll take only 12. 12 crores into 45% divided by 2 divided by 2. Just a second, the screen is troubling me. Yeah. Again, coming back so that we don't lose track. We have 12 crore shares. 12 crores shares in the S Limited. So 12 crores. I'll not write crores, I'll just say 12. Each share has a face value of 100. Okay, so divided by 100. We have acquired 45%. Okay, we have acquired 45%. Valuing each share at 10,000. So 12 crores divided by 100 into 45% into 10,000 when we do, we get 540. We get 540. I think I have and some calculation again. We have 12 crore shares, each having a face value of 100. So that is the number of shares. For every 2 shares, we are issuing For every 2 shares we are issuing, or we have acquired 45% of these shares. For every 2 shares we are issuing 1 share, so divided by 2 multiplied by 10,000 is the value per share. We get 270. We get 270. What is this 270? 270 crores is the purchase consideration by way of shares issued. 270 crores is the purchase consideration by way of shares issued. Okay. Then fair value of existing stake. Now for fair value of existing stake, what we have to check is what is the value per share on the date of acquisition. So here the question has given on the date of acquisition, means on the date of obtaining control, value per share is 395. So we have how much share? 15% stake. 15% of 12 crores divided by 100. Why am I dividing by 100? To get the number of shares. 15% into 12 divided by 100 into 395. What I get is 7.11. So that is the fair value of existing stake. So shares issued 12 crores divided by 100. Of this we have acquired 45%. Of this we are giving 2 shares for every 1 shares held. Value is 10,000. So this is the fair value of shares issued. Then fair value of existing stake is 7.11. Right. So that is one part. Then the other part is there is a contingent consideration. There is a contingent consideration. Now what is the contingent consideration? And before the contingent consideration, they have also said they have paid 50 crores in cash. So cash paid 50 crores. Contingent consideration, they have agreed to pay 22 crores as on 1st of March. Now please remember, the fair value on the date of obtaining control should be considered and not the subsequent fair value. So 22 crores is the fair value of the date of acquisition. So my my purchase consideration is how much? 349.11. Purchase consideration is 349.11. That is the first part of the question. No, that is the first part of the question. Then what will be the goodwill or bargain purchase? So first we have determined purchase consideration. Second step, we need to determine net assets acquired. Net assets acquired at fair value. Net assets acquired at fair value. Now again we will have to see what is the fair value of the net assets. Each item will consider PPE. Fair value is 90. Fair value is 90. Now please remember, in this case there is a deferred taxation implication. So we need to compare that with book value also, or carrying amount also. So carrying amount is 40 and fair value is 90. Then intangible assets 20, 30. Then investments 100, 350. Then inventories 20. So inventory there is no change. Then financial asset, trade receivable 2020, trade receivable 2020, cash 44. Okay. Then non-current asset held for sale. Please remember, non-current asset held for sale is not taken at fair value. It is taken at fair value less cost to sell. So it will be 4 only. So here also there will not be any difference, right? So that is on the date of acquisition. Now there is a customer relationship which we need to check. Customer relationship we got to know subsequently. We did not know on 1st of January. So that part we will have to ignore on 1st of January, right? Then we have the liabilities side. We have borrowings. Borrowings is 20. Then we have trade payables 28, 28. Then we have provision for warranty 3, 3. Then we have current tax liability 4, 4. Okay. Then subsequently I have said that yes, there are two contingent liabilities we have to take. So contingent liability 2.5 fair value. Carrying amount is 0, fair value is 2.5, which we will consider in our books. So fair value of the contingent liability is 2.5. Right? Now, what we need to understand is we have calculated all of this, and for this contingent liability there is an indemnification asset of 1 crore. So indemnification asset, nothing in the books, 1 crore in the financials, nothing in the books, and 1 crore in the financials. Now we have calculated the net asset, but because there is a deferred tax implication, we need to calculate the deferred tax impact also. So differences. Now, what is the difference? See, there is a difference between the carrying amount and the fair value. Means we are increasing the value in the books, but for tax purpose we will not increase the value. So for example, you have 40 worth of PPE. For tax purpose, it will be 40 worth of PPE only. But for the books purpose, we are increasing the value. But the book value has increased, but tax base has not increased. So this will result in a difference which can be either taxable or deductible. Which can be either taxable or deductible. The best way to learn or best way to understand is if the amount as per books is greater than tax for assets, if amount as per books is greater than the amount for tax for assets, then it will result in a taxable temporary difference which will create a deferred tax liability. So that is one thing. Okay, so in this case, I have increased the value in books. My tax depreciation will be lower. My tax depreciation will be lower. My book depreciation will be higher. Means I have a higher tax liability. So that will create a deferred tax liability. So if the asset is higher, now here my asset is 90, my tax base is 40. Because after I incorporate the asset, my carrying amount will increase, but the tax base will not increase. So this 50, 90 minus 50, this will result in a taxable temporary difference. Same way, this will result in a taxable temporary difference. This will result in a taxable temporary difference. Here no difference, no difference, no difference, no difference. Now this indemnification asset is giving a difference of 1, but here if you look at the question, any amount which would be received in respect of above undertaking shall not be taxable. So because this will not be taxable, the indemnification asset related difference will be 0. Indemnification asset related difference will be 0. Okay, then borrowings 0, this is also 0, this is also 0, this is also 0. Then we have a contingent liability of 2.5. We have a contingent liability of 2.5. Now here, please remember, one of the contingent liability is for income tax demand. Now income tax will not result in deferred tax liability or deferred tax asset. So here, what we need to consider, we can split into two parts: contingent liabilities, contingent tax. Okay, so contingent liability normally, which has minus 0.5, this will result in a difference of 0.5. This will result in a difference of 0.5, whereas the tax, which is 0 here and minus 2 here, this will not result in any difference because it is an amount of tax payable. It is not an amount of deductible or taxable income or expense, right? So with this, what we have is total difference of 309.5. 309.5, if we apply the tax rate into 30% of tax rate, what we get? 92.85. Now this 92.85 is my deferred tax liability. This 92.85 is my deferred tax liability. If you have not yet covered, IAS 12, it may be slightly difficult for you to understand this, but definitely when we cover IAS 12, you'll be able to understand why it is a deferred tax liability. Now this deferred tax liability that we have calculated, that will also form part of our liability, which is 92.85. Okay, so the net assets that have been acquired will be sum of all of these, all the assets minus all the liabilities put together. We have 368.65. We have 368.65. Any questions so far? Okay, now the question says NCI has to be proportionate. NCI has to be proportion of net asset. Now NCI is how much? 100% minus 45 minus 15%. We have 45% plus 15%, 60%. NCI will be 40%. NCI will be 40%. So NCI value will be 40% of this number, that is 368.65 into 40%, that gives me 147.46. Now to calculate goodwill, I have to take purchase consideration 349.11, NCI 147.46, the total 496.57, net assets 368.65. So 496.57 minus 368.65, we have 127.92. 127.92, that is the goodwill calculation, the first part. Okay, second, will the amount of NCI goodwill or bargain purchase change subsequent to 31st March of year 7? If yes, provide the relevant journal entries. So first part, you have calculated goodwill. Second part, what has happened? There are some changes. There are some changes. Now we have to see which change do we need to account for and which change we need not account for. So there are some changes which needs to be accounted for. There are some changes which need not be accounted for. Now, of all of the changes, if it is information that gives us additional evidences of facts and circumstances existing on the acquisition date, then we will consider those changes and give an impact on goodwill. But if there are changes because of subsequent events and circumstances, for example, here if you see this 22 crores becoming 23 crores, the fair value has changed. We have not got any additional information, so that will not be considered. Whereas customer relationship, which was existing 3.5 crores, we will consider that. Now customer relationship, when did we recognize? We recognized or we identified on 31st of May. We identified on 31st of May. What is the value? 3.5 crores. And the question says that there is no differences associated with this, no impact on income tax. Now this 3.5 crores, the customer relationship that I have identified, what will that do? That will increase. That will increase my identifiable assets and it will reduce the goodwill. What I am trying to say here is my net asset now will be 368.65 plus 3.5 on 31st of May. 368.65 to 372.15. My purchase consideration is the same. My NCI will also change, 372.15 into 40%. So my goodwill will be 125.82. Now if you see the difference, purchase consideration did not change. NCI increased by 1.4. and assets increased by 3.5, goodwill increased by 2.1. So the customer relationship increase will increase the goodwill by 3.5 into 60%. So why only 60%? Because we are following proportionate net asset method. We are following proportionate net asset method. That is why it will have an impact on the goodwill as well, only to the extent of the balance part, that is 40%, 60%. Then NCI will increase because NCI share has increased 3.5 into 40%. This much will be going to NCI. So what you will do is you will say customer relationship 3.5 to customer relationship 3.5 will increase to goodwill. Goodwill reduction is 2.1 to NCI increase 1.4. So this is how we will account for it subsequently. What should be the accounting treatment of contingent consideration on 31st March of year 7? So contingent consideration has increased. Now that contingent consideration, it's a financial liability which has increased, you will account for it in P&L. The increase of 1 crore, you will take it to the P&L. A very lengthy question, but a comprehensive question for us to understand how do we calculate, how do we handle scenario changes and all of that. A very important question from the examination point of view as well. I hope this is clear. Okay, no questions. So we have solved 3 questions, to be frank, like 2 AX BX related and 1 this question. This would have given a good understanding of how do we address questions related to business combinations in the examination. Now we are left with some small topics tomorrow, which we will complete, and then subsequently we'll start consolidation if time permits tomorrow. Okay, till then have a good day. Practice enough number of questions. And if you have any more questions to be discussed, please let me know in the group. So thanks a lot for joining in. Have a good day.